let's go. Cool, guys. So, as I mentioned before, for the people who are joining in the last couple of minutes, if you don't have a pen and paper, first of all, make sure you've got something to take some notes of what we're going to be going over in today's call. Now, if there's one call from me that you ever listen to and make sure you understand in full, it is this exact call. And the reason for that, and I explain this to people all the time, the most important skill set in trading is not knowing how to trade itself. It's knowing how to manage trades, know how to manage your account and manage your risk. Now, I always put this really funny and stupid example to illustrate this point, but also you'll probably be familiar with this yourself. Now, I'll give you two different examples. Number one, one of the most successful hedge fund traders of all time was a fellow whose win rate was 19%. Yeah. So one for context, that means he won 19 out of 100 trades and lost 81 out of 100 trades. Yet was one of the most profitable traders of all time. Why? Because of what we're going to go through today, the risk management. Number two, a silly example, but which also illustrates this point. Let me know in the chat who has seen it was like a viral thing on social media, on like Reels and TikTok and stuff, where the chicken chose the trades. Has anyone ever seen that before? Let me know in the chat if you have done. Where someone's pet chicken chose whether they bought or sold gold. No. Okay, cool. Right, fine. Well, this illustrates the point. There was a guy, right, who did a series. I'll try to find it if anyone's interested, where he gets a green button and a red button and puts chicken feed on top of both of them, and then lets his pet chicken into the room with two buttons that say buy or sell, and lets the chicken decide what button it wants to go to every day. Whatever button it goes to, whether it's buy or whether it's sell, that's the trade he takes randomly at that point in the market. And because he manages the trades well and he uses positive risk reward, the chicken makes money in the market. Now, it's safe to say every single one of you guys on today's call are more intelligent than a chicken pecking for seeds, right? And therefore, this is going to illustrate why this call is so important. With whatever strategy you're armed with, whether that is signal IQ, whether that's scalp trades, whether that's swing trades, whether that's live calls, whatever, you should be and can be making money if you manage your risk correctly. So now we've got the whole storytelling past. So, Lisa, anyone selling a chicken? Sometimes, mate, I think I need that Mr. Chicken in my office giving me a hand, bud. So now we've got out of the way. First of all, I'm going to ask you guys a few questions, right? We're going to start with determining your risk per trade. I'm going to assume you guys all have this sorted, right? I'm going to start at the beginning and work my way through this as if I'm talking to a group of people who don't have any idea when it comes to risk management, right? Argentina are just one bastard. Turn that off in the background. Tired of seeing lean on Messi's face. Right. Let me know in the chat. Do you guys know what risk you're taking per trade? And first of all, if you do know, if the answer is yes, what does that look like to you? Is that a percentage? Is that a number of pips? How are you managing that? So Jim says 3 to 4%. Sam says no. Jim says per trade. Lovely. Ryan saying 1%. Okay, cool. So you guys are getting, for those of you who say no, some of you say yes, right? First thing you need to know is determining what you are happy to risk per trade. And it has to be a percentage, like Jim just said. This can't be I'm looking to risk a number of pips, yeah? Because there's different traders all everywhere, right? So if I'm speaking to a variety of different communities right now. Some of you guys in some communities have 3 or 4 different traders. Some of you guys have 2. Some of you guys have just the one, right? The point is it's going to be relevant regardless of what situation you're in. The first thing is if you're trading multiple trades, then your lot size isn't going to stay consistent from trade 1 to 2 to 3 when trade 1 has a 40 pip stop loss, trade 2 has a, say, 70 pip stop loss, trade 3 has a 60 pip stop loss, and trade 4 has 150 pip stop loss. So the key thing here, right, is you need to make sure, regardless of what trade you're taking, if they're coming from different sources, if you're taking your own trades and you're using a dynamic risk, so on some trades you'll take 60 pip stop loss, some trades you'll take 40 pip, some trades you'll take a 70 pip, that your percentage risk on your balance is the same. Now, before I get into how to calculate this, because I'm going to make this part fairly quick because this is the complete basics, but why is this important? Well, because if you're just trading 0.1 lot, right, per trade, right, in example one over here, your risk is $40, or in pounds, right, it's going to be a little bit less, but you get the point. I'm doing it in dollars because it's a whole number. It's easy for me to quickly calculate in my head. This is going to be a $70 risk. This is going to be a $60 risk, and this is going to be a $150 risk. Now, do you understand why this can be a problem? Because if the trade which you lose is this trade right here and you lose 150, but then you take a trade with a 60 pip stop loss, which is a great trade if it goes 60 pips the other way, bear in mind, because that's positive risk reward. It's the exact same way if trade number 4 with 150 pip stop loss runs 150 pips, then at that point it's a good trade. If it runs 50 pips, it's a shit trade if you close it, right? Because you're closing less than you've risked. Do you understand the point I'm getting at? So say you place trade number 4 here and you lose minus 150 pips. And then you place a trade with a 70 pip stop loss. And let's say here you do a 2-to-1 or 1-to-2, I should say, risk reward trade, which basically means for every £1 you risked, you gain £2, which is a fantastic trade. In this trade, you make 140, but you're still in loss because you lost one trade here. So you've done a very good trade and then you've hit one stop loss. You should be in profit, but you're not because you're using a flat lot size, right? This is why it's so important. Now, the way I would work this out to simplify this really simply for beginners is work out your lot size per 10 pips. Okay? What do I mean by that? You can work out what lot size you're going to use on gold for every 10 pips, and then you can really simply calculate what your lot size should be on each individual trade, right? Now, how do I, sorry, ignore that. Let's it's a little bit more complicated than that. I'm jumping ahead before I actually go back through what I'm working out. Right, say like someone said in the chat, they're saying they take 5% risk, and your account balance is, let's say, what do we want to use? So let's use 1,000 balance. Yeah. Now, bear in mind, all the examples I'm going to do are in dollars. I'm just doing it in dollars for the purposes of this, so I don't need to apply a currency calculation. Yeah. If this was calculated in pounds, we'd have to currency convert. Because gold's traded against the dollar, it's easy to run the numbers quickly in my head as dollars, right? But you can apply the currency conversion. Just Google it. This would mean you're taking $50 risk per trade, right? Risk per trade. And therefore, you can use so zero. Let me just work this out in my head. $50 risk per trade means, God, my brain's not braining this morning. With a 0.1 lot, it would be 60. $60 risk. So what's 0.1 divided by 6 times 5? Just do that with my calculator. Ignore what I'm saying here, I'm just working out, and I'll give you the rule, and then you can run with the rule, yeah? 0.1 divided by 6 times 5 is 0.08, okay? Here you go. So 0.08, and then I want to multiply 6. Okay, cool. To give you a rough idea here, right? You'd be taking 0.08 lot size, yeah, with a 60 pip stop loss to risk £50 per trade on this example. Do you guys understand how I've got to this, right? Say yes or no in the chat. If you don't, then I'll try to go through it in a bit more detail for you. Yes, you understand, right? So all we're working out basically is for every $10, for every 10 pips in the market, a zero point 0.1 lot will risk £10 or $10, sorry. So we've just scaled it down for 50. Maybe what I should have done for this example was done $60 risk per trade. It'll make it easier for you guys to follow along, right? So every $60 risk you want to take, you want to take 0.1 lot with a 60 pip stop loss. So now you know that. Say your risk that you're having to take is 60 per trade. Well, then if you're taking a trade with 40 pip stop loss, what's your position size? Let's see who's first in the chat. Hayden says 40. Hayden's got Lambo lots on the go. Hayden's saying he misheard the question. So I'm just going to ask again. I've seen loads of answers coming in. If you're taking a 0.1 lot with a 60 pip stop loss, which means you're risking $60 per trade, if you also want to risk $60 with a 40 pip stop loss, what lot size are you using? Dun, 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 dun. Do, 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 do. Cool. I can see more right answers than wrong answers. 0.15. Why is that? Because for every 20 pips of this stop loss, right, it's a 0.5 here. So if you ignore that, actually, I'm calculating that wrong. Why is my brain not working at this time in the evening? Where are we? 0.1 lot with a 60 pip stop loss. So obviously we want to increase our lot size, right? Because the stop loss is tighter. So yeah, like Steve has just said, it's in thirds, right? So it would be 0.1, sorry, 0.1. Well, I need to do it on calculator, mate. My brain is not working. There you go. 0.133. Yeah. 0.133, which you just round down to 0.13. Yeah. And hopefully you guys understand what we're doing here. Now that means if you're taking 120 pip stop loss, your lot size is 0.05, and so on and so forth. Yeah. I hope you understand where we've got to this one. Because the stop loss is double the size, we half the risk, right? Because this stop loss is smaller, we're increasing our risk in the same proportion, like Stephen's mentioned in the chat. This is important because one thing that I see people make the mistake of, and I'm not pointing any fingers here, but it's something that I see from people time after time after time again, is they're taking different trades all the time with different size stop losses, or with the same position size on every single trade, which basically means, like I showed you in that example at first, you're going to have some trades which, when you lose, if you get unlucky and you lose the trades with a wider stop loss, you're losing more. And then you win a trade with a smaller stop loss, but because we're targeting a smaller number of pips for a positive trade, you're making less. And then you fall into the whole ballpark or the whole remit of losing more than you're making. Yeah, which is not where we want to be. The whole purpose of this call is going to be showing you, first of all, how we determine this risk. So hopefully you guys understand this. If you don't understand this and you're feeling a little bit confused, that's absolutely fine. This is just a mathematical thing to work out what your position size should be. If you get confused, just reach out on any of my live calls and just put in the chat your example, how much you want to risk percentage wise, what your account balance is, and I'll just tell you, okay, for every 10 pips on a stop loss, this is what your position size should be. Yeah. And then you just work it backwards from there. Really, really simple. Right. So if you don't understand this, great. Lots of you seem to understand it from the chat, so we'll move on. Now, this is the first thing because you want to basically make sure every single trade you take the same risk because this is going to put the probability in our favor. Now, before we move on to this, can you guys tell me in the chat why would layering be an issue here? Can someone let me know what I want to say here? Why can layering cause an issue with this? This isn't to say layering is incorrect, because layering perfectly does have its place in trading. Yes, it's when it's layered badly, right? Because not because the risk, yeah, Clayton's bang on the money. Because what you can do, right? Say if we look at this previous example here, right? Let's just take all of this away and go with this trade here, right? Well, you may be thinking I can take the same lot size, right? Because a 0.01, I can divide up into five equally sized 0.02 lots, right? So I'm always going to take a 0.1. But you don't know how far, like Clayton has said, this trade will fill a zone for you to get five trades. So let's give you an example. Trade number one, so I want to do T1, you may get one 0.02 entry and then the trade goes into profit. And in that example, you've got 0.02 lot running in profit. Trade number two, you get three entries times 0.02. And trade three, you get five entries, 0.2. If you lose trade three, your loss is bigger than all of these two previous wins, right? Do you understand this? Because you're trading a bigger position size on that trade. So layering perfectly does have its place, and I'm going to get into this on the next section when I talk about entering trades. But the key to remember, the key to learn here is when you layer a trade and when you don't. Because I always explain this, and the reason why I've decided to do this call today is I always get asked loads of questions, right, about what percentage of a trade do I exit here? Should I layer here? Should I close here? And the answer of that is only without seeing your account and going through it and saying, okay, this is how you should manage it. The answer is going to be different for 99 out of 100 people. The answer is going to be different, right? Which is why I'm doing this call to try to teach you to think how I'm thinking when I'm managing a trade, right? And that's the reason why I was saying I had a call with a couple of my team the other day. I had a really good call with Aaron the other day as well, and we were saying this like there's like loads of people who are even despite my personal trades not being the best they have been, right? And like I said, just let hold my hands up to that. But I'm still making money. There's still people making money, but also there's lots of people not making money, right? And that comes down to the trade management. So let's move on to how to enter a trade. So you've got your lot size, right? So let's just say we're going to use for the rest of this call 0.1 lot per trade. And I'm going to do this with my trade layout, right? You can apply this to whatever trade layout. It doesn't matter. The whole theory behind it is the exact same. So I'm going to apply this to a 60 pip stop loss, right? Now, the key thing here is you want to first of all make sure you're not entering a trade if it's not in the entry criteria, right? Really straightforward. If you're entering based on signals, right, you need to have an entry in those entry parameters. I know it's so easy to look at something and be like, oh damn, it's only a little bit outside. You know, it's only I don't know, 20 pips away. Let's enter this. You're then going to get a different result to everyone else because when everyone else takes their risk out of the trade, you're only in a tiny bit of profit. Now, because of spread, the broker might not allow you to bring your stop loss to break even. So then you hold it, hoping it goes up a little bit more. If that trade reverses, then you're going to end up taking the drawdown and the stop loss where actually you should have been break even. So the key thing to note here when we're talking about entering a trade is if the price isn't between the entry parameters, you can do one of two things. You either wait till it is, or set a buy or sell limit for those entry parameters, and then wait. Yeah, that trade, if it's my own trade, is valid up until the point one of two things happen. Until it's either done 40 pips, yeah, with a 60 pip stop loss, or I will say this trade is now invalid. Right at that point, you can cancel your order and you missed that trade. But that is the criteria, right? If it's not hit 40 pips, and I've not said it's invalid, you just set your limit order for that zone and just let it tap yourself in. 9 times out of 10, it comes back into the zone, right? So rather than you rushing in because you're worried you're going to miss it, actually, if you waited another 30 seconds, you would have got that optimal entry, and then you can manage it in the same way how the trade's designed to be managed. That's the first thing. Now, I'm going to speak about how to layer a position because layering certainly has its place, right? I layer multiple trades every so often. Some trades I don't layer at all. Now, this is going to come down. Like, at the moment, what we've been speaking on really is managing risk, right? Basically saying how we're going to take the same percentage risk on every trade. Yeah. And how we're going to make sure that we are taking that same percentage risk by getting the entry in the right place. That's the two most important things to manage our risk. That way, you know every trade you take, this is the risk that I've got, right? The problem that lots of people have, and I'll be honest, I've been through this when I was learning to trade. I see people have it all the time. The point where people get stressed about holding a trade which is losing is when they don't know what they're going to lose if it hits stop loss, right? If you predefine these parameters, then for me, I'm not stressed, right? I know, okay, I went into this trade knowing, right, and we're using $60 for the purposes of these examples. When I'm placing a trade, I'm taking one lot per trade, right? I'm risking $600. I wouldn't enter that trade myself if I wasn't happy to risk $600 on that trade. Yeah? If I've already to myself internally accepted that if this trade goes wrong, that is the risk that's attached to it. I think that trade's worth taking. It's worth that risk. Yeah. If you don't have that in your head before taking a trade, then ultimately the whole emotional side of trading comes out, and that's when mistakes are made. Mistakes are made in trading when your emotions come into your trading decisions, right? We're trying to take those emotions out by following something fairly systematic, yeah? Steve says, what about, I think it was say 4192 and it goes to 4197.7. It's happened to be loads. I've waited, never actually here. Steve, what I would say, you if it's this is very difficult to give you like a flat rule because where do I say the cutoff is? Do you know what I mean? Look, if we're saying selling at 4192 and you see it at 4191.7, then look, that's not the end of the world to me. Whereas 4191 is too far because that's quite a big difference when our zone that's a quarter of the zone, right? Here you've got 30 cents in a 40 pip zone. It's not the end of the world. The reason why I don't like saying that for one of two reasons. One, because price is always moving. So you might click sell when you see the price at 4191.7, but then the market executes you at 4191.3 because prices move at that moment between when you click buy and when you click sell and when you're actually entered into the trade. And then you've got a little bit less wiggle room. So look, as long as you're not doing it all the time, it's absolutely fine. Try to stick in that zone, right? But like use a little bit of personal judgment to it. You're going to get this is kind of going to make sense when I go over the account management side of things, because when we talk about how we're going to manage the account, this will all kind of come into play. You'll hopefully start to see when, okay, it's fine to layer here, or I should be closing this trade here, or I should close this amount here, because what we're doing is we're managing a dynamic balance in our account. Yeah. So, so stick with that, mate. If I've not answered it fully, then hopefully when I circle back, it will make sense. Rob says, I'm that strict, I know myself at times. I won't layer it unless it hits the minimum 20 pips. Could be 19, it's still that in some. Yeah, good mate. I like him. Right. So a big part that we're gonna Kate can we have some advice for those of us at a 0.01 lot and a tiny account? Kate, can you hold that question till the end for me and re-ask that? If you just copy and paste it and I will answer it at the end. Um just whilst I'm in the swing of what I was going to go through. So we talked about determining your risk. We talked about when you should enter a trade. The thing here is I'm going to revert back to whether you should layer or not layer. The key thing now, which we're going to talk about, and this is why we're all joined on this fucking call tonight, right? Is right. We know most of us, on the whole, know how to determine our risk, or we know really that we should be entering within the zone. The key thing, the reason why we're all on the call is because we want to fucking make money, right? That's the reason why we're trading in the first place. So we're going to talk about exiting trades, and this is where a little bit of finesse comes into trading because lots of people will mess up the whole exiting side of the trade. Everyone knows where the stop loss is, right? If you're not setting a stop loss, look, that's on you. You have more money to risk than I do. I set a stop loss on every trade because I want to define my risk, right? Everyone knows that's the rule by this point, I will hope, right? If you don't, then now you know, right? The rule is you set your stop loss. The key is when you exit the trade. This all comes down to risk reward, right? I'm going to write this on screen in all capitals. this is what the most key thing is about trading. What your risk versus reward is. And the reason why before I got into this, I explained all of the different examples of okay, you've got this trade with this stop loss, this trade with this stop loss, is so you understand that this is going to vary on a trade by trade basis, depending on what the how big the stop loss is, right? It's also going to vary dependent on your own account. What we're going to do, we're going to go through a couple of trade examples, yeah? And we're going to go through a couple of different personal examples as we're going through this, right? Now I'm going to just pick random points on the chart because the purpose of this is really not to show you some like great trades, right? We're just back testing and we're just like giving you an example. I'm just going to show you. I'm going to draw 5 random lines on the chart, unless we're going to say we entered a buy at every single one of these points, right? In 5 random places, and how you would manage your account based on this, right? Yeah. Now, obviously, the result at the end of this doesn't matter. These are 5 random points. What does matter is how you manage these trades. So this would have been the world's worst buy, right? Because it immediately went into drawdown. So let's mark out the trade so you get the point. Well, don't even need to mark it out, right? If you enter here at 30, we're buying, it's gone down into drawdown. On this first trade, so trade numero 1, T1, you lost 60 pips. I'm using my strategy for this, minus 60 pips, which means I'm going to assume you're risking, let's say, let's do 1% of your trade. So you're down 1%. You're minus 60 pips or down 1%. Now let's come over here to trade 2. These are 5 trades we're going to imagine are all on the same day. Yeah, I think they are for the purposes of this, but let's imagine they are. Now we go to trade number 2. Now, what should your goal be here? Because this is a mistake I see people make all the time. And when people try to get a little bit greedy, yeah? Your goal shouldn't be to come and make money in this trade. Your goal should be to recover this loss, first and foremost. Yeah? Because you want to get back to at least break even for the day. Now, if you can position this so you get back to break even and you leave a runner, even better. But at the minimum, you should not be coming. If this trade 2 runs 60 pips, there should be 0 scenario that you let it come back to break even and come away with nothing. Yeah? Because then you're ultimately falling into this bad pot where you're not managing trades correctly. You have the opportunity to fix a bad morning, but because you tried to go for glory in the second trade, then you messed up. So let's say you entered, yeah. So you took a buy position here, right? Where are we down here? La di da di da. What are we? 14125. So you see it comes up 25. 60 pips is at 31, which it hits, right? At this point, you want to either close the full trade. One of 2 things you can do here. Yeah. I would say 90% of you should be closing this full trade. I'm just going to bring this back down here and recovering plus 60 pips. Yeah. Then you're back to break even on the day. For those of you, now this is where a little bit of finesse comes in. If this is Tuesday in the week and you're in profit on the Monday, so this 60 pips isn't the end of the world to you. You could do one of 2 things. You could close 50% here, yeah? Or the better option is close 50%, but rather than leaving your stop loss at break even, leave your stop loss at the original stop loss, which is basically just making the trade risk free, but giving it a little bit more room to breathe, right? So, but one of 2 things, unless your account's in positive, the immediate rule here is you should be recovering this loss. Coming back, trade free, you're back at break even, right? And then your mindset is back in positive. If this trade, let's say you didn't do that, and it comes all the way back down, it stops you at break even, then your trade free comes in, and then now you're just playing catch up, right? You've lost 60 pips, you've then hit a break even, you're in the doom and gloom, you're in the shit. That's like the example I said earlier today. My first trade lost, I recovered my loss on the second trade, and I tried to leave a runner, ultimately got break even. I've not lost any money. So then I go into the next trade with a clear head. Yeah? That's the way that I like to try to kind of manage my account at the beginning. Now, that's given the example that you lose the first trade. Now, it's not going to be that situation all the time. the key thing here is at least try to come away from the day not in negative. Now you go to trade free, right? Okay, this is a great example that I'm giving you because this one would have been a loss. Still, you go back to minus 60 pips on the day. Then on trade free, then you're closing 60 pips again, and you would miss out on this move, right? But that's not the end of the world. At least you come away at break even. Rather than what I see lots of people do, and this will hopefully illustrate this point, right? For those of you who don't follow this and say, no, I'm going to wait out for the runner, trade two, you make 60 pips back. I don't know, it's trade two, you get back to break even, sorry, because you try to hold out for a big runner. Trade three, you lose 60 pips again. Yeah, because that third trade went straight down. Now, by the time trade four comes, I'm going to use a name in the chat. Rob is absolutely fuming. Yeah, he's busting his balls. He's telling the missus to fuck off because he's really pissed off that he's lost a load of money for the day. So what does Rob do in this scenario? Trade four comes along. He enters this buy here, sees it run up into 20, 30 pips profit, and closes the trade. Because then you're now in damage limitation mode, where because you've lost money for the day, you're down 2%. You're just trying to make the situation that little bit better. So Rob closes his trade here. Then he sees everyone else saying, oh my God, look at the money we made in the chat today. And then Rob's kicking himself even more. Now, this sounds so bloody stupid. And it sounds so bloody stupid. I've purposely tried to illustrate this to make it sound stupid. So you guys hopefully see the point I'm getting at here, right? If you manage your account badly, it's going to be the difference between you making money and you not making money in the market. Yeah. Whereas if Rob used this trade to come back to break even, yeah, then trade three loses, then trade four, he's already closed 60 pips, right? He's recovered his loss. At least Rob ends the day, yeah, it's annoying, I didn't make money. But your mindset's clear, and it's not going to be the end of the world, right? It's going to be rare you get these kind of break-even days, right? For example, I think it was, I don't know what day it was, maybe Monday last week. My first trade was the day did like 400 pips, okay? Because I'm not trying to recover a loss on that trade, I'm making most of that. I'm making most of that profit, yeah? And then on the second trade, the third trade, the fourth trade, I don't need to play this back to break-even game. But when you're in a situation like this, your main priority is you want to basically be making sure you're not losing money because there's always another trading day, right? We're in the markets 5 days a week, 20 days a month, whatever 20 times 12 is. Someone do the quick maths. 140. No, my maths is fucking useless. What's 20 times 12? 240. 240 days a year. Christ, that was slow of me. We get the point. There's 240 trading days every year. You're going to catch these runners. But if you're in a situation where you're managing them badly, then one thing leads to another, and then you start losing money. Then you think, oh Christ, there's been no trades today. Okay, maybe I should jump on the chart and I'm going to try and make some of that money. I lost back yesterday because it's 8 o'clock in the morning. I was really hoping I'd make the money back. So you place a few of your own trades. One thing leads to another. You lose more money, and you're like, where did this all go wrong? Where really all you did was just not close 60 pips in profit. That was your mistake. Yeah, and you see what I'm getting at here. One thing leads to another, which leads to another, and you end up spiraling and blow your account. That is I promise you, I've spoken to hundreds, if not thousands, of people learning to trade. Every single person falls into this exact same pattern when they're learning to trade, simply because they don't understand this process. Now, let's try to find an example, a better example of what you do on a good day when you win the first trade, right? So let's just cherry pick this one. Yeah, you get the point. And let's go for 4 more random points on the chart. Yeah. And you'll see how this is going to differ. Let's go boom here. Right? Hopefully we lose the second two. Let's move it so we do lose the second two. Yeah. Cool. And you'll see how this is now going to differ and why your management differs then slightly in this occasion. And then we're going to circle back to then when you layer. Yeah. Or when you decide I'm not going to layer. So trade number 1. Okay, cool. You wake up in the morning, 6 o'clock on a Tuesday. We've placed the trade at this moment in time, right? Your first goal here with this trade, your profit and loss is at zero for the day. Now, obviously, I factor in what's happened in the week so far. I factor the month in as well. When you're starting to implement this, just look at it on a day by day basis to start. As this it progresses over time, then you can start thinking about the week, thinking about the month, etc. Yeah, and this will all fall into place. But just think about it every day so far. Trade number one comes in. We enter a buy. Every trade's going to be a buy, just to make this example really straightforward. Enter at 17, 60 pips in profit is 23, right? Up here. This hits pretty much immediately. Now, you have one of two decisions to make. You either bank this profit and your next trade is free. Yeah? What do I mean by that? Well, you bank 60 pips. If the next trade hits stop loss, you're back to break even. Or your option number two is you close 50% of the position and you leave the original 60 pip stop loss below. Because what have you done there? You've basically just break evened it. But rather than bring your stop to break even at the entry and having it tight, you've left your stop loss down here. So you've given your trade 120 pips of breathing room rather than just 60 by closing 50%. So if it came and hit stop loss, you break even, but you've got much higher probability of this continuing to run. Option number three is you do nothing and you let this trade either be break even at entry. You shouldn't let this trade ever hit a stop loss. So if you're going to hold this, if you're not going to do option one and close the whole thing, or option two and bring this stop loss to break even and hold it, yeah. So if you're not going to do option one and close the whole thing, or if you're not going to do option two and close 50% and leave the original stop loss, you should never be losing this trade. It should be at minimum break even. Then what you can do, this trade you see, this trade continue to run. Let's run all the way up to, let's say, wherever this point is. 29. Cool. This trade's now done 120 pips. Now you could either say, okay, cool, I'm going to close 50% and keep letting it run with break even, or I'm going to close the whole thing and the next two trades are free. So I can afford to lose the next two trades and I go back to square one, right? But you see how we're managing this. All I'm continuously thinking about every single trade is my risk versus reward and my P&L for the day. And I'm always thinking, I don't really want to go into a situation where I'm losing like 2, 3 trades back to back and just keep going and going and going and going and making the situation worse. That's why I set a hard rule with this, right? And you guys should all set the same thing. And this is going to depend on all of your risk tolerance. It's going to depend what your risk percentage is. Hey, for those of you who are risking 1%, then maybe you're a little bit more happy to lose 2 or 3, 4 trades in a day because you're like, cool, it's not going to cause catastrophic damage to my account. A few of you guys mentioned in the chat earlier that you're risking 5% per trade. Look, that's absolutely fine. What you want to risk is what you want to risk. But no, should you be hitting 1, 2, 3, 4 losses in a day? Certainly not, because then you're blowing 20% of your account in a day. You don't want to be in that situation. Whereas 3% is not catastrophic. 20% is a fair old chunk, right? So for those who are risking 5%, you may say, okay, cool, I have a 10% maximum daily loss. If I hit 10% loss, regardless if I see 20 more signals today, I'm not going to take them and I'm just going to come back fresh. I know lots of you are going to sit here thinking, I'm going to do this, guarantee sod's law, say when this happens, yeah, you do this, the next 10 trades all hit take profit and you think, fuck, why did I not enter those trades? I tell you what, you will manage them so badly after losing that 10% on the first two trades that it won't even matter. Yes, in hindsight, you'll be like, I would have held those all the way to TP4. But would you actually, after you're down 10% on the day? Probably not. You might close the first one in a little bit of profit, the second one a little bit in a little bit of profit again, so you won't even get back to break even. And then you'll sit there and kick yourself even bloody more than if you just left it. Because you'll be sitting there like, I could have come back to break even. I had the opportunity, I took the trades, I closed them early, right? This is super important. So look, let's say you close this full trade, 120 pips, you're now up 2% on the day on the first trade, right? Now, we come back to trade numero 2, right? So you're up 2% on the day, fantastic, great start. We're now going to buy again. We buy right here, on this candle down here, 35. Okay, this is an example of when you could This is the first example that we've had, and we've been going through these couple of different example days where you could consider layering. Yeah. Why is that? Because if you could either layer two trades on this, because you've got two free trades, right? So you could have two of your full lot sizes on this drawdown, and worst case, you're back at break even. I don't want you to be in a position where you layer this trade and you layer five entries, and if it hits stop loss, then your account goes into minus on the day. Again, this is where layering goes tits up. This is what I was mentioning before, right? Layering has its place in trading. It doesn't mean that you layer every single trade. Okay? So you may say, okay, I'm on 2% for the day. I'm kind of happy with that. So actually what I'll do on trade number two is I'll divide my lot size into three, and I'll enter lower risk on the first entry, and I'll wait. And if it comes into a bit of drawdown, great. If it doesn't, look, it doesn't matter. I don't need to make a full 1% on the next trade because I already have established a buffer for the day, which is that 2% of the first trade. So you might layer here, layer again, layer again. It'll take some partials, end up getting taken out of break even. Let's say you got up to 2.5% on the day. Yeah. Either 2.5%, or you entered one entry, and this probably ran 60 pips, did it? No, it didn't. Right, so this would have been break even. One or the other. You either layered this trade and closed a bit of partial because your best entry is down here at 34. In that case, it's ran a one-to-one risk reward because this 34 entry, yeah, the stop loss is only 40 pips. So you only need to target 40 pips in positive for that, which is up to 38. So this entry you close in a bit of profit. You make that 0.5%, everything else gets break even. Cool. Yeah, but you see my point. If you aggressively layered this trade and it lost and it was your first trade of the day, then you'd be in the shit and you're playing catch up. So this is the first rule. You don't layer until you've established a buffer on your account. Then you can start considering layering. Yeah. If you're not in profit, you should not be layering because then you're throwing out your whole risk reward. Does that make sense? Hopefully that makes sense. Yeah. All you got to think about if you're layering is, am I going to, if this trade hits stop loss with my layers, do I go into negative? If you do, the answer should be I don't take that trade. So whether that's the first trade of the day, and if it hits stop loss, of course, you're going to go into negative. Or if it's the second or third or fourth or fifth trade of the day, am I going to go into negative? Am I overexposing myself, meaning that I'm going to go into loss despite having this buffer? If so, don't place the layers. Really, really simple. Trade number three. Right, we have a loss. So you immediately go down to 1.5%. Yeah, on the day, I say lovely stuff, not so lovely, but you get the point. Trade number four, funnily enough, is at the exact same entry point as I drew that previous line. So you enter here, right, 35. Trade goes up to 37, which means stop will be to break even. Trade gets break even. Cool. You're not pissed. You're not in drawdown. It's fine. We move on to the next trade, which is all the way in the north of England up here. We've got a trade here. Again, you take your position, 66. It goes up to 75. It's done 90 pips. In this scenario, because you're now in profit, you don't need to close 60 pips. Are you guys following? You can, for sure, and bring yourself back up to the 2.5%. Close the whole trade it and bring yourself back up to 2.5%. But you could say, look, I'm happy to hold this out. Yeah, a little bit further and see if I can maximize this because I'm not risking anything on this trade. You get the point. I'm not risking my money. I'm risking today's P&L. They're two very, very different things. Trading is a game. I promise you this. It's a game about not trying to make as much money as possible. It's about trying not to lose your money. Yeah? We can take risks with money that we made, the market's money. I'm happy to risk that. I don't want to be taking loads of risk on my capital. That's how you build a trading account, by risking this beautiful number here when you start to have a good day. So trade number three comes in, you enter at 66, we come up, we go to 60 pips, which is up here at 72. Then you might say, okay, cool, I'm going to continue to hold this trade. You either bank it, you're up 2.5%, or you continue to hold. Now we move up further. Where did this go to? This goes up to 75, yeah? 74.92. If I actually do it to the wick, it's 75, I'm pretty sure. 75.19-ish, right? Say it goes up to 75. Now this trade is running plus 90 pips in profit. Now, we're going to go through two different scenarios about what you do here. Let's say scenario one, which is S1, is you are at plus 0% for the day. So this is your first trade, right? And scenario two is you're at plus 1.5%. How can you manage this trade at 90 pips in profit? Well, scenario one, like I said, you want to be securing some profit. You're either closing the whole lot, yeah, or you're at least closing. So you're minimum closing the whole lot, or at the bare minimum, you're closing 2/3 of the trade. Why am I saying 2/3? Because 2/3 of the trade is 60 pips, which is securing the next trade. Do you understand that? Yeah. So if you're floating 90 pips in profit, and let's say you've got, I don't know, say you had a 0.1 lot traded, you close 0.0. Oh, what am I doing? 0.07, which is 0.67, is 2/3, right? You leave a 0.03 to run. You've secured 60 pips by closing this. So you've secured your 1% risk, and then you let it run. If it comes back to break even, your next trade is free. Yeah? You do not, you do not in this scenario close nothing and let it come back down to break even. Yeah? If you're up nothing for the day. The key you always need to be thinking is this is the golden rule in trading, is that buffer. Where are you? What is your result? Yeah. Your trading decisions will depend on your individual circumstance. Because let's say this, like we've like see Vicky on the call, Tracy, Richard, Mo, Jim, all five of you guys, your situation on the day can be very different. Tracy could have had a line, so she didn't place the first two trades. Richard could have placed the first two trades and been running 1.5% in profit. Mo could have done the school run in the morning. She placed one trade, but her kids were yapping in the back. She's turned around, told them to piss off, and she's missed the trade, right? You get the whole point. Everyone's situation is different. That's why I've been saying like continuously to people like, when should I close the percentage at a set percentage at each take profit level? Should I be doing this? Should I be doing that? It's really difficult for me to answer that because I'm like, well, look, this is what I would do in my situation where my account is on the day. But that situation is very different to you. Tracy said, I thought you said I had a line rather than a lion. Bloody hell, that's my is that my London accent? That's terrible. Right? You kind of get the point. In scenario two, you're up 1.5% for the day. You've got one of two options. You don't need to bank anything if you don't want to. Yeah? You just don't want to lose. You want to protect this buffer so your stock comes to break even. Maybe you trail your stock to 30 pips profit because it's not the end of the day if your negative risk reward on that trade. Because if you lose the next trade, you're not going back to break even. You get my point? So you can close 30, 40 pips here. It's not the end of the world. So you either trail your stop loss, you bank the 90 pips. What I would do in scenario two is close 2/3 of the trade, secure 60 pips and leave a runner. Yeah, with my original break even. So you're in these trades which run. Like let's just say the next trade is fine. Let's just, for example, use a sell here. Right, we've been using buys and now we're using a sell. What I'm trying to get at is you want to leave as many opportunities as you can for when you get a runner like this, that you're not closing all of it at 60 pips. And this is what I'm getting at here. Good days come in trading, yeah? When you're gonna get 5, 6 big running trades a day, and you are having a great day. You don't want to build a bad habit when you're not getting those kind of trades. So when you get these trades, you're not in them because then you're going to kick yourself even harder. And hopefully this is the point. Is everyone following so far what I'm getting at? I'm trying to be as like fucking passionate about this as possible, so it kind of drills the point home. Because despite me, I mean, like I said before, I spoke to so many new people in trading, and you can see this exact same mistake. All you need to do is scan through someone's P&L on their trading account to see whether they're doing this correctly or not. All I need to see is the SLs are bigger than their take profits, and I'm like, cool, you're not managing your trades right. Yeah? You should never have that situation unless you're in profit, unless you want to bank a little bit more, right? So the next thing to follow on from this is how can we make this easier for you guys? Now, I'm on the live streams as of late. I've been advocating for you guys to start journaling. For those who haven't been on those live streams, some of you guys have work commitments, whatever during the day. I'm going to send a link into the group after this call of a trading journal spreadsheet. Please, for those of you who want to take trading seriously, download that and just make the effort to fill that in every evening or at the end of the week and go through it and start to tweak this over time because you will see. This call's being recorded. Actually, is it been recorded? I really fucking hope. Yes, it is being recorded. Jesus of Nazareth. I almost had a heart attack there. I thought, did I press the record button? I thought, no way. I'm gonna have to do this all over again tomorrow. This call's been recorded purposefully, and we're not quite finished here. I've still got a little bit more to cover. But the important thing is, I don't want you to go away from this call and continue making the same mistakes. It's fine to make a mistake in trading. Not changing and fixing those mistakes is you're never going to progress. And hopefully you see the point here, right? We've literally picked random points on the chart and said how you would just manage a buy at every single one of these points. And this is me just randomly selecting points in the chart. This has no strategy to it whatsoever, apart from the trade and risk management. But hopefully you're piecing together now. When we start then putting a strategy behind the trades and start getting some decent results, how this then works really well. But this can work. It's the same. If I circle all the way back to the beginning, some of you type it in. I really want you guys to watch those videos of the chicken placing the trades, and you'll see this is the first chicken that's a profitable trader, right? Just because they manage their trades well. Yeah. So what? Let's look at the chat. Tracy says it's helpful to understand. Yeah, looking at the whole account rather than one trade at a time. That is like the most important thing. Hopefully you guys now see when to layer, when not to layer, right? When do you close partials? The two things you want to think about is where am I? And I'm not thinking like Tracy, she's sitting in the front room, or like Vicky, he's probably lying on the floor because I can see her ceiling on the camera. So she's probably like lying on the floor. I don't know, maybe in a sunbed or something like that. The point is, where are you in your trading account journey? What's your P&L? All of that. That's super important. So where am I? Put brackets. Trading account. Number two is risk reward. I talk about this all the time, right? If you've layered a trade, your risk reward's slightly different. You can close a little bit earlier because let's do a layering example just for this, right? So I've kind of explained when to layer. Now I don't want you guys now I'm going to explain this point. Now go blindly layer every single trade, right? Apply what I've just explained, but just so you understand how layering works. You have a zone up here, and I'm going to use round numbers to make your life really easy. But this is any zone, right? I'm just going to use an example of one of my trade setups. Yeah, with like the same sort of like pip parameters. So you follow this, it can be applied to any zone. It makes no difference. 1994, right? So you've got an entry zone, which is 40 pips. You're 60 pips from the original entry. How do you manage this? So let's say you can layer this trade, right? Yeah, so our scenario come up here. So hopefully you understand that this example differs in different scenarios. So scenario 1 and scenario 2 and scenario 3. Scenario 1 is first trade, 0% profit and loss. Scenario 2 equals second trade up 2%. Right? 2%, I'm assuming you've risked 1% on each trade, and therefore this is a 2-to-1 risk reward, right? So you can think of it two different ways. Scenario 3 is in a loss, -1%. Right? Hopefully you guys are getting the point here that 3 different people on the call today could be in each of these different scenarios, depending on whether they missed the trade or whether maybe they didn't manage the first trade as well. So some people made money, some people didn't. Everyone's in a different situation. So scenario 1, first trade, 0% P&L. Now, let's think, where is price when this person at scenario 1 enters the trade? Let's say we're in the middle of the zone. Absolutely fine. You can go ahead and enter the trade. You shouldn't layer. Use your full position size for 1% risk. Okay? Let's say we're up here. Oh, where's my arrow? Let's say price is up here. Do you enter the trade? I'm hoping you're all thinking, absolutely not. Great. Scenario three, we're at the beginning of the entry zone. Do you enter the trade? Absolutely, it's fine. This person should not be layering. Let's say we all understand this second point, right? When to enter. Let's say this person enters right here in the middle of the zone. So their entry is therefore 1998. Yep, right here. For scenario one person, right? Their stop loss is therefore what? 40 pips. So when can they close the trade? Well, they can close the trade before 60 pips from 2000, which is the rule that I say for everyone to make it easy, yeah, because it's a blanket rule. But they can close their trade before 2006 up here. They can actually close their trade at 2004 when everyone else is bringing stop to break even. Why? Because they're covering a 60 pip stop loss on the next trade. Yeah? So you can close your trade slightly earlier. Fantastic. If you entered up here, so you see what I'm saying here, right? If you entered here, you have to wait 60 pips all the way up to 2006. If your one entry is here, you can close at 2004 and get that first trade on the door. Or you wait for 2006 when you're up 80 pips and you close 75% of the trade to bank the 60 pips. Yeah? Scenario two, person's up 2%. They decide, okay, rather than taking 1% risk on the trade, I'm going to halve my position size and I'm going to layer twice. The trade comes here and starts moving up. How does this person manage the trade? Well, actually, no, it's fine. Let's do this. How does this person manage the trade? Well, look, it's not the end of the world. Yes, you're not covering the next trade, but you're in profit. Your first trade has already covered your risk. So look, you're running in profit. If you want to close the whole thing at 60 pips, just bear in mind you're actually only closing 30 pips because you've got half your position size. It's not the end of the world. In this scenario, what I would do, right, really straightforward, is I would bring my stop to break even fairly early. Yeah. If we come back down deeper into the zone, your first entry here at 2000 gets stopped at break even, but you had half risk anyway. You're in profit for the day. You can enter again here. Yeah, you can re-enter this even if I've said the entry is not valid, right? You might think, well, look, I like this trade. I'm up for the day. I'm happy to re-enter this zone. Yeah, because I'm not risking my balance. I'm not saying to everyone to do this on every trade. You're getting the point though. This may also, right? You take your first entry, it comes back down into the zone. You take another entry here, so you've got better entry with less risk. Then you take another entry because you layered again. Now you've got your full 1% risk. Yeah, because you've layered this twice. Your average entry, because you've got entry one here, let's say at 1999, one entry here at 1997, your average entry is where? It's bang spank in the middle here at 1998. Yeah. So you've now brought your entry price down 20 pips. You've only got a 40 pip stop loss on that trade. So you're in a much better position to start taking out risk and closing profits. Yeah. This is a scenario when you can consider layering. In scenario one, where it's your first trade, 0% P&L, or if you're in a loss, then it's a no-no. Yeah. Does that hopefully make some sense? I need to have a tea with someone. What to share? There you go. This chat, I've got this horrible chest infection and been dying to blow my nose for like the last hour, and I've been looking around looking for a tissue. Not found one anywhere, so I've been like holding it in. If I've sounded like a bit croaky for the call, then I apologise. Right, I'm going to open up some questions because that's kind of what I plan to go over. Is hoping to start to show you guys how lots of people spend too much time focusing on how to find the best possible entry, yeah, and not on the actual trade management side of thing, which is way, way, way more important. Like, if I was, for me to be completely honest, I'm not just saying this because I've just done this call. A great trader is 70, 80% this and 20% the actual trading. Like I've met some people who have literally been trading for 2 months and incredible traders because they do this well. And actually, they'll send me a trade. I'm like, what the hell is that? I wouldn't take that. Yeah. But they're making money because they're doing this correctly. And they're knowing when to take out a bit of risk, when to start closing, when to do this, this, and this. Whereas if you're kind of thinking, like I was saying before, I'm in a loss for the day, let's just bank 20 pips, let's get something. Yeah. Then you're actually doing yourself an injustice. In yourself emotionally, at that moment, you're thinking, I'm doing something good. I'm recovering a bit. But actually, you don't realize you're making the situation even worse for yourself by thinking you're doing the right thing. So, does anyone have any questions on that so far? Um, Jim says, mate, yeah, lovely. Jay says I'm the entertainer now. You know what, bro? Like I said on the call this afternoon, man. I've had a really shit day. I'm not gonna go through it with you guys. It's not the purpose of this call. I had some really shit news this afternoon. Don't worry, no one's died, which is what everyone probably immediately thinks when I said that. Because I got a few messages after the call, like, bro, are you okay? I'm like, don't worry, everyone's alive. But yeah, just had some bad news on other things. Right, so before all of you are worrying about me, like thinking, Jesus Christ, these are Oscar's depressed. That's not the case. But I just like needed a couple of hours to recoup my thoughts, and like we're back in the game. I'm back to myself. Adam says, why not move stop loss to plus 60 pips and then let it run if it's at 90 pips? Adam, absolutely fine. You can absolutely do that. So Adam's question, just to clarify and show you guys on the chart, is let's say because Adam, there's absolutely nothing wrong with that in the slides. Let's remove some of these lines, clear up our little example here. Adam says, almost feel like, remember in school when everyone said Simon says? So I feel like Adam says, put your hands on your head. Oh, I just caught Tracy putting her hands on her head. So Tracy's listening and playing the game. Right. So Adam says, right, say trade goes up to 90 pips in profit, right? So we're running up here, we're 90 pips in profit. Adam says, why can't we bring our stop loss from break even up to 60 pips in profit? And you absolutely can. Now, I like to, I'm always kind of thinking, how can I give myself the best possible chance of leaving a runner here? And like in the same way, let's think about it this way. If you're only leaving 30 pips as a stop loss, is it not fair to say this is quite likely to happen, and then you get a runner, right? Which is why I'm giving you guys like different ways of managing things, which is again going to depend on where you're at. If you're up for the day, cool. Look, you might be happy to add another percent to your account. This is cool. Some of you might be thinking, well, look, I'd rather try to leave this a little bit more breathing room. And in that scenario, like I say, close 2/3 of your trade. So if you were up one lot, close 2/3. That is doing the exact same thing as bringing your stop loss here, but it's actually leaving a stop loss down here. So you're banking 2/3, yeah, and you're more likely to get a runner and not get stopped out. Mate, it's just different ways to skin a cat, ultimately. But there's nothing wrong with what you're saying there. As long as you're not bringing your stop, as long as you're securing profit and it's in positive risk reward and you're making money, I've got absolutely no problem with how you want to manage it. What have we got here? Richards in a nice cell. How would you manage to count as small and only use a 0.01 lot? Cool. Let's go through some examples for this. So, Claire, the first thing what Claire said is, what do we do if we've got 0.01 lot? Lots of you guys will use trading small accounts and therefore using what we call a micro lot, which is 0.01. Obviously, if you've got a 0.01 lot, you cannot close partials. That's the smallest position size you can. So you have to approach things a little bit differently. Yeah. You can only take one entry for first thing. So you're taking one entry when it comes to the zone. You've got a 60 pip stop loss. You want to always, of course, make sure you're securing 60 pips. Because you can't close partials, I would always on the first trade until you're in profit, close 60 pips and run every trade at a 1-to-1 risk reward because you can't close any partials. However, if you're in profits, then look, trail your stop loss slightly, Clem. So for example, you could bring your stop loss. Look, you're in profit for the day. If you hit stop loss, you're still going to be in profit. Trail your stop loss up to 2002, for example, and try run it that way. You're in a much harder group, I guess, to manage in that scenario. because closing partials allows you to give that trade the breathing room, like I just discussed, whilst also securing the trade with profit. If you can't, focus on building up a bit of a buffer, and then you can just trade a stop. It's honestly, the only thing you can do, Claire. um, yeah, hopefully that kind of answers your question. But yeah, the first thing is obviously just don't let yourself keep going up to 60 pips in profit, coming back down to break even, and doing that every time. Like secure something, get some profit on the door, and then you're gonna have to trail or stop and do it that way. Or leave it at break even and accept a few break evens to try to catch a runner. It doesn't matter, you're not in a loss. Um, but it's really the same kind of rule. You always want to be thinking, how can I start to secure some profit? Yeah. Um, Rich says I just move stop loss down so still can catch pips. Exactly. Yeah. So Richard said the same thing. So he's trading on 0.01 and he's trading his stop. Yeah. So just trading your stop. I'll show you a good example on a chart, Claire. Let's just say I'm going to cherry pick this, right? So you've got an easy example. But let's say you bought here, right? Your trade runs up, it's around 60 pips. You might bring your stop loss up here to 30 pips. It moves a little bit higher, starts doing its thing, right? Then what I would do after it's starting running some profit, which is like 60 pips plus, we start creating structure like this. I would simply just trail my stop loss. Like we've created this high up here. I'm going to trail my stop loss just below this low. So if we continue trending up, I'm going to stay in the trade. If we break this low, then the trend probably breaks, and then I want to be out of the trade anyway. Yeah. So I'll trade up to that low, then we come up, make another higher high. I'm going to bring my stop loss below the most recent low. Then we come up again, make another higher high, and bring my stop loss up to just below the most recent low, and so on and so forth, and trade it up in that manner below the lows each time after we've got that next push up. But yeah, hopefully that kind of makes sense. Right. Mm. Adam, this is a great. This is fantastic. What Adam's just put. Where's my little example up here? Oh Christ, it's gone all out of whack. How do I put it back? We have to stretch it up again. Adam has just said something which is fantastic. I didn't want to go over this on today's call, so I didn't want to give you like too much and like overcomplicate things. But since you mentioned this, Adam, then I'm going to. Adam said in this example here, right? If you got in with if your first entry, you enter in the middle of the zone right here at 1998. Yeah. With your full position size, which would be 1% risk at 60 pips. But this trade's only 40 pips, so you actually have less than 1% risk. Then of course, yeah, like Adam says, you could enter another full position size down here. Yeah, do you kind of get that? So what you think, if you're only ever trading 0.01, you would have a zero point 0.2 or two 0.01s here, but actually your risk is the exact same as having just one 0.01 up here at 2000. Does that make sense? Because up here you've got 0.1 lot with a 60 pip stop loss. Yeah, 0.1 lot at 60 pips risk. But like Adam says, if you have 0.1 here and 0.1 here. Oh, that arrow's back to front. There we go. This 0.1 is at 40 pips stop loss, and this 0.1 below it is at 20 pips stop loss. So you've actually just got 0.1 at 60 pips stop loss in total. Yeah. So in that scenario, you've got an even better potential trade if this hits because you've got double the balance. And yeah, it's the exact same thing. Just as long as your risk amount is the same on every trade, it's fine. But yeah, that's absolutely fine. Uh, right. Vicky says needs to watch it again. The recording will be out. Vicky, honestly, I would say don't stress out if this is confusing. Because like I said a minute ago, this is where most people go wrong. I speak to so many people, which when they like analyze the chart, I'm like, everything looks fucking great. And then I'm like, why are they not making money? And it's because they don't get this. So if you're confused, it's kind of a good thing because most people mess this up. So at least you'll start like, yeah, you might be slightly confused, but you're starting to pick this up. This I guarantee, like if I don't know how many people are in the call today, over 100 people. If all 100 of you do this and learn this, I guarantee in a month's time, 99 or maybe 95 out of 100 of you will be making money in trading. Regardless, even if you're just taking your own trades. Yeah. At least there's an AI summary of this call would be super helpful. I've got no idea how to make that, mate. But I could post a recording and if you've got any idea how to like feed it into some sort of AI bot, please do share it. Chances on a small account, 0.02 lot would be the ideal risk to reward. Should I close the entire trade at TP2? So again, it's going to depend, Shivan, where you're entering. Yeah, it's also going to depend. It's also going to depend on where your account balance is on like a trade by trade basis. Like I went over before, participant has asked you to start transcription. Hopefully that will do it for the whole lot, rather than just start for now. Whoever asked that. Um, so yeah, this is kind of what I mentioned before. It's on a kind of trade by trade basis. If that's your first trade of the day, yeah, close it at TP2, bank 1% if that's your risk and 0.02 lot, and then on the next trade you can try hold a little bit further. Um, just the focus should be on building up that buffer, and then you go and then you try get the runners. Rather than trying to get the runners at first, keep hitting break even, then getting frustrated and closing a small amount of profit or a stop loss, and then you're like kicking yourself, right? Rather than, and I see people do it all the time. They'll they'll try to hold out for a TP4 and 5. The first two trades will hit TP2, go back to break even, TP2, go back to break even. Then on trade number 3, when there's a runner, people who managed it correctly are in that trade. Those of you who didn't are now forced into closing early. Whereas you don't want to be forced into closing early. You should almost close early by like consciously close early because you're trying to build that buffer and then consciously allow the trade to run rather than letting your emotion in trading dictate when you close the trade. Be kind of strategic about it. Is kind of what I'm trying to get out. Uh, just a stupid game in subconsciously ingrained in me. Tracy, like just to illustrate this point as well. Honestly, and I promise you this, trading is almost you have to rewire how a normal person makes decisions, right? Because like a normal rational human when they've lost a bit of money is going to take what they can. That's why so many people do make this mistake because it's just a rational thing to do. Whereas actually, when hopefully when you guys see it explained like this as to why it's actually not rational, you're actually stabbing yourself in the foot. Then it will start to make sense. And like honestly, just by doing this, you'll start to ingrain it out of you. You'll start to become less stressed about trading, and then like the results will come. But this is almost like counterproductive of what most people think managing trades are. They're just trying to recover losses quickly and like leaving trades to run or adding to losing positions, etc., etc. And actually, it's the worst thing to do. Right. I think uh, CB says, do you personally trade on MT5 or TradingView? Alt analysis on TradingView, and I execute on MetaTrader. We've already addressed that one. That was from the Simon Says comment. I don't know why that came into my mind, but here we go. Right, do we have any other questions? Gold's melting, apparently. Jesus. Holy motherfucker. I'll be honest, I have no clue. On like make up some rubbish for you guys. I'm super transparent. Let me have a look at Bloomberg News Terminal. See, we've had a headline. I'm too busy teaching you guys that I've not even looked at the chart. Let's refresh this. What's the latest news? What time did this start selling off? 7:45, which was 30 minutes ago. Um, Oh, I'm going for too far back. We've got it's re-escalation in the Middle East. 28 minutes ago, which if we look at the time is like back right here when we start selling off. Iran has put out a statement saying the actions in the Strait of Hormuz were wholly unacceptable to the United States and will be met with consequences. So yeah, they're US revoking US is revoking Iran related general license to export oil. Yeah, it's just all kicking off in the Middle East again, which is why we've got this big old sell off. If you guys ever see anything like this, I'm gonna share with you guys a Twitter account. Follow this Twitter account. Turn on post notifications for it. It is basically the best thing you're gonna get to a $20,000 a year subscription for a Bloomberg terminal. I'm gonna post a link in right now into the trades channel. Um, if you don't use, well, say Twitter is X now, but yeah, just follow that guy. Turn on all post notifications and enable push notifications for Twitter, and you'll get pop ups. This basically through like New York and Asia session will give you real time news updates, and you'll see them come in here before like gold news before it comes up in your general mainstream media. You'll get it here first, like every time. Every time I see something like this, I'll go check that and I say, okay, cool, it makes sense. Right. I think that is everything, guys. I'm going to stop the share really quick now. How do I do that? Where's record?